Welcome to the Allen Resources video seminar series. My name is Fernando Diz, and I'm the Whitman Associate Professor of Finance at the Martin J. Whitman School of Management at Syracuse University. Today we'll be talking about Level 2 derivatives. And let's start by talking about forward pricing. Let's first define what forward pricing is all about. Pricing a forward contract is simply finding the forward price such that the initial value of this forward contract equals 0. Now, in order to do that, I want to establish some well-defined notation. We're going to talk about time all along this series, and whenever I talk about time equals 0, it means we are at the current time. Time little t is any time between current time and the time to expiration, which is cap t. And now that we have the timeline jargon out of the way, let's make some assumptions and see how we can use the arbitrage technology to find the forward price or price a forward contract. So let's suppose that you see the following prices. Gold cash price for immediate delivery is $400 an ounce. This price is often called a spot price or the cash price or the price for immediate delivery. The borrowing rate is 5% on an annual basis, and the forward price that we observe in the market is $440 per ounce. So those are the three pieces of information we see, and we'd like to see whether there is an arbitrage opportunity available given those prices. So let's now explain how and whether there is an arbitrage opportunity and how we can use that to fairly price a forward contract. Now let's pursue the following strategy. Let's borrow $400 at 5% for a year, and we do that in order to buy 1 ounce of cash or spot gold at $400 per ounce. So we borrow $400 at 5%, and the cash flows at time 0 are equal to plus $400. Why? Because we borrowed the money, cash is coming to us. And what is the amount? We'll call it S sub 0. So S for the price of the underlying, which is gold. We buy 1 ounce of gold at $400 with the money, with the proceeds of the borrowing. So what is the cash flow? When we do that, is minus S sub 0 or minus $400. We borrow $400, we use the $400 to buy 1 ounce of gold, and at the same time we sell one forward contract on it. And remember that the forward contract has a forward price of $440, but selling the forward contract doesn't provide any cash flow. So the value of this forward contract, let's say, is 0. It doesn't provide any cash flows. So the total cash flows from this transaction at time 0 is 0. In other words, remember, if you've gone through other series, that the definition of arbitrage is a trading strategy that requires no out-of-pocket equity, has probability of making money without any probability of loss. Now, at the expiration of the contract, cap T, what do? Well, we repay the loan and the 5% interest, and that is a negative cash flow of $420. 400 times 1.05. 05 is basically the interest you pay per year, or $20. So the total outflow from repaying the loan is $420. And since we have sold one forward contract, what we do is we deliver the gold that we had and get paid for it. What price? The forward price. And the forward price was $440. So we get a cash flow equal to the forward price of $440. The total cash flows at the time of expiration are basically the difference between the price we get paid for the gold we deliver minus the financing cost, which is principal plus interest, and that gives us $20 per unit of this transaction. Now, what you see in this transaction is that there is no equity cash required at the initiation of this transaction. The value, therefore, of this portfolio initiation is 0, but its cash flows are positive at the end. So this is clearly an arbitrage opportunity. It costs us nothing to get into a portfolio that would have positive cash flows at the expiration of the forward contract. So this clearly is an arbitrage opportunity. So based on the previous analysis, what would be the forward price such that the cash flows at the end or at the expiration of this forward contract would be equal to 0? Well, if you basically look at the previous slide, you'll realize that those cash flows will be equal to 0 when the forward price is exactly equal to the financing cost, or the forward price minus the financing costs equals 0, not $20 per unit. Then that implies that the forward price has to be equal to the cash price at the initiation of this contract plus the financing or cost of carrying costs. Now, let's talk about the values of this contract over its life. At time 0, if we set the forward price such that it is equal to the cash price plus the cost to carry, the value of this contract, denoted as V sub 0, 0 big T, should be equal to 0. At any arbitrary time between the time to expiration and the original time, it should be the difference between ST and the present value of the forward price. And at expiration, the value of this contract equals the difference between ST and the forward price. Those are the three values that you're interested in: the value at origination of the contract, the value at any time between the origination and expiration of the contract, and the value at the expiration of the contract. An off-the-market forward rate agreement is a forward contract such that the value of this contract at origination, this forward contract, is different from 0. If the value of this contract is greater than 0, that means that the long pays the value. If the value at origination is negative, it means that the short pays the value to the long counterparty. But what you have to remember here is that an off-the-market forward contract is a forward contract whose value at origination is different from 0. Let's now talk about equity forward contracts. What is the difference between equity forward contracts and other forward contracts? Well, the only difference is that many stocks pay dividends. In other words, there is a distribution, a cash flow distribution from the underlying asset to the owner of the underlying asset. That is the only difference between a forward contract, say, on a commodity like gold, and a forward contract on equity like a common stock, share of common stock. In that case, the forward price, the no arbitrage forward price, we also call it the fair value forward price, would be equal to the difference between the current stock price minus the present value of the dividend payments, everything multiplied by 1 plus R, or the financing cost, or we can call that the carrying cost of the underlying. So the only difference in pricing a forward contract on a dividend-paying stock would be that the current price of that stock should be adjusted by the present value of the dividends paid over the life of that forward contract. Remember then that the present value of the dividend paid over the life of that forward contract is simply the sum of the present value of the dividends over the life of that forward contract.